So you're thinking about using home equity line of credit, HELOC, to renovate your property or to buy another rental property, right? Before you do, I want you to watch this video because I show you exactly how to use HELOC, because if you use it the wrong way, it can actually destroy your wealth building journey. So what is HELOC? HELOC simply means home equity line of credit. This is where you have some kind of equity in your home, typically more than 30% of equity. Let's say your property is worth $1 million, but your loan balance is $700,000. Now we can say you have 30% equity in your home. The beauty about HELOC is that you only pay interest on any money you use, which provides you that flexible you're looking for, and also you can reuse the money over and over again. As at August 2025, the average HELOC rate is around 8% to 9% depending on your credit score and depending on the quality of the mortgage lender that you are working with. One advantage of HELOC is that you can actually use it to buy your next property or use it to renovate a property without you having to refinance your property. You can use HELOC to buy your next investment property, like I said, and that can save you around 3 to 4% interest rate, because let's assume that you currently have a mortgage of 3% interest rate right now. For you to tap into your equity, you can either sell the property and realize a gain, or you can refinance. Now, let me even give you another example. Let's say you have a property that is worth $500,000 and your loan balance is only $200,000. Now you can say you have equity of about $300,000. You can now go and get up to 70% of that $300,000, and you can use that to buy your next real estate. What I always advise is to use it for income generating assets, not a liability. That is, you want to use it to buy another income producing asset like real estate, like business, not going on vacation, doing expensive wedding, buying luxury cars, luxury watches, among other things that does not put money into your pocket. So if it does not put money in your pocket, especially while you sleep, it is most likely a liability. Now, many of my clients actually use HELOC to do a BRRRR, which is you buy, you rent, you renovate, and you refinance, and you repeat the process again. You'll be able to rent that property out, and that will be like extra income for you on your property. Again, income producing asset being the keyword, not a liability. The number two reason why people always use home equity is that you can actually tap into that your home equity as a down payment to buy another property. Either it's your primary residence or it's a rental property. Imagine you have $100,000 equity in your home right now. Then you went to the bank to get HELOC on the property. Then the bank will give you up to 80% of your $100K equity. In this example, they will give you $80,000. Out of that $80,000 you got, now you use $30,000 as a down payment to buy a duplex, let's say in Houston, Texas. Now you can still use this as your primary residence. Now you can rent out your previous home that you were living in and live on one side if you choose to, or you keep living in your existing home and rent out the 2 units if you choose to. So now from one property, you're able to free up some money as a down payment to buy another investment property. Now you have 3 rental properties simply by leveraging your existing home already. I've helped so many clients to do what I'm telling you right now. One of them is Sarah in Katy, Texas, who used her home equity. She has about $258,000 at that point, and she was able to get up to 70% of that money. She used it to buy a duplex in Houston, Texas, and of course she continued to stay in her current home while she rent out the 2 duplex, the duplex that I help her to acquire. So again, this is very, very practical, and you can do the same if you're ready to take action. The number 3 advantage of using HELOC is that interest rates can be tax deductible if you use it to improve your property. Now, for you to do this, you need to work with an experienced CPA, not a regular tax preparer. You need a rockstar CPA. So IRS does allow you to deduct all the fees, all the interest, all the cost of you getting the HELOC, because again, they want to encourage you to buy assets and provide job and provide housing for people. So they do incentivize you in a lot of ways, which is one of the reasons why I do put all my money into real estate. And as always, you want to consult with a rockstar, CPA, a lawyer, because this is not a financial advice. I'm not a financial advisor in any way. I'm just sharing information that has worked for me and that has worked for many of my clients with you. So take this with a grain of salt. You do want to consult with your own CPA before you implement whatever I'm teaching here. Now, you have to understand that you cannot claim a deductible on this if it's a credit card or it's a use it on vacation, or you use it to buy luxury. So again, it has to be income producing asset, or you have to use it to renovate or improve your property. Now, there are cons to HELOC as well. Number one of them is the variable interest rate. Interest rates on HELOC are not fixed. They are variable. That is, they go up and down. Most of the time, they kind of stay around 8 to 9%, as what I've been saying in 2025. So if you cannot undo the variable rates, you might just want to go with a loan, which is called e-loan instead of HELOC. So if you carry a balance too long and the interest rate add up really fast, this might be a problem for you. HELOC rates, as what I've been seeing, is around 8 to 9% as at 2025. So again, you want to make sure you work with a rockstar lender that can advise you on your option. If you want to get a recommendation from my lender, shoot me a DM on Instagram at wale_lawal, and I'll be able to connect you with my lender that will make this happen for you effortlessly. Now, the number two cons is that HELOC can actually hurt your credit score if you didn't use the debt wisely. Again, you want to make sure your debt to income ratio is under 45% when you're applying for HELOC, because this will give you a better opportunity to get qualified for the highest possible, and it will also have lesser impact on your credit score compared to if you're already around 55% DTI and above. Like I said, HELOC is like a line of credit, and using more than 30 to 40% of this can actually hurt your utilization score when it comes to how the credit bureau reports your credits. Now, the pro tips here when you are getting HELOC is that you don't want to get the maximum you can get. So don't max it out unless you know that what you're putting the money to will generate a passive income for you immediately, so you can start attacking the HELOC and start paying it down immediately after you close on that HELOC. Now, the number three cons is that your home is actually the collateral. Like I said at the beginning, is based on the equity you have in your home. If you don't have any equity, you can't even do HELOC in the first place. So the bank will be using your home as a collateral to borrow you the money. So what they are simply doing is that they are becoming number two position on your property. You still keep your primary lender, your lender still remain the same. They are just becoming number two on your property. So if you have lender A that borrow you the money when you bought the house, they remain in place. You keep your 3% or 4% interest rate. The lender 2 now, which is the bank doing the HELOC, will now become the secondary borrower on that property. Now you can say you have two loans on that property. Now, what you should pay attention to here is that if the market actually shifts and you default on your payment, you could actually lose your primary residence. You could lose your home. So this is why it's very, very important, again, to use HELOC for only income producing assets. So above all, this is a business move, not an emotional move, and you have to work with a rockstar investor agent or a very good mortgage lender that understand how to actually successfully use HELOC, not just to buy liability. So the question is now, when should you use HELOC? You should use HELOC for all good cases. Like I said, use it to buy assets, use it to buy cash flowing rental properties, use it to buy business that pay you consistently. You can use it to increase the value of your house by renovating it, additional unit, maybe you have some extra space in your house. Again, you see, everything I'm telling you is something that will put money in your pocket, not a liability. This is very, very important. Now, here are a few bad examples of how you should use your HELOC. So you don't want to use it to buy consumer goods like your cars, going on vacation, doing expensive weddings. You don't want to use it for short-term flip without safety cushion or without experience. You also don't really want to use your HELOC as your emergency funds replacement, because emergency funds should be coming from the money that you have worked hard for, that you don't have to pay any interest on. Now, I have personally used HELOC to buy rental property myself, and I've also helped a lot of people to free up the home equity they have in their house and get HELOC and use that HELOC to buy another property. One of them is actually Sanjay. Sanjay actually closed on his property last month, where we helped him to get about $120,000 or so from his property, and he used that as a down payment to buy a duplex in Houston, Texas. Now, it all comes down to this. If you are using your home equity to build assets or to buy a rental property, absolutely go ahead and use that money, right? Go ahead and use the HELOC. But if you are going to be using it to buy liability, please do not. So before you apply for that HELOC, I want you to actually schedule a Zoom consultation with me. You'll find my calendar link in the description below. Let me understand your situation. Let's take a few minutes to actually discuss it and actually decide if actually getting HELOC is your best option, or maybe there are better options for you out there. And even when you eventually get the HELOC, let's go through what are you going to be using that money for, because by doing that might save you thousands of dollars and sleepless nights by simply having a 20-minute conversation with me. Again, you can find the link to my calendar in the description below. Before you go, I want you to watch this next video of Sarah and Marcus of how I helped them to go from $0 in passive income to now cash flowing around $39,000 per year in pure passive income that they don't have to do anything, and they did this in 4 years. And you can do the same thing as well. I call it the slow wealth building strategy through smart rental property investing. So it is very simple. They are just regular people like you, and I'm sure their story will inspire you. Thank you so much for watching the video till the end. I do appreciate the time you put into this, and I cannot wait to see you in this video of Sarah and Marcus. Thank you. Peace.